Hey everybody, welcome to this video. This is Smoleny from Wolftrader Futures, and this is going to be a webinar on inflation. I just want to make sure that everybody can hear me. So I'm going to do a few little tests here and then we'll get started. So can everybody hear me okay? Everybody see me okay? See the video feed? Just let me know in the chat how that's looking to you, and then we can get started. All right. Okay, so welcome to this webinar. Looks like we got sound and everything's going okay here. Today I'm going to talk to you about inflation, and the typical definition of inflation that you may have, I think, is going to change a little bit because of the environment of the Fed. But I'm going to lay out a series of arguments as to why I think we're entering into an inflationary period. And I think we're starting to see the early signs of that. It's very early, but the one thing I would ask everybody is to keep an open mind and try to understand that we need to look at this through the perspective of what's going on with the Federal Reserve, not necessarily how past inflation has worked. So that's the biggest difference here. So let's get started. So first of all, I'm going to start out with a disclaimer, as I do with every webinar. Trading commodity futures involves substantial risk. Past performances are not necessarily indicative of future results. Services include products that are traded on margin and carry a risk of losses. The products may not be suitable for all investors. Please ensure you fully understand the risk involved. Wolftrader Futures is an educational service that is designed to be a supplement to the book A Trader's Guide to Financial Astrology by Larry Pesavento and Smoleny. Wolftrader Futures is separate from Mr. Smolen's firm Trading Ridge Analytics, LLC. The information and strategies presented in Wolftrader Futures are completely independent of any strategies or operations employed by Trading Ridge Analytics. The data used in the creation of astrological, planetary data, charts, and cycles is public information and is already reflected in underlying futures prices. So that's it. That's the introduction here. And for those of you who don't know, who are new here, you can reach me at a variety of places. We have a YouTube channel for Wolftrader Futures. Obviously, you're here now, but you can sign up and become a member of that. We have an Instagram page, Wolftrader Futures. I also have two Twitter feeds, Wolftrader Futures, which the first one's the free Wolftrader Futures. It's Wolftrader FUTU1, and then Wolftrader 1 is for gold members, and a gold member is somebody who subscribes to all of the packages. And then the website is wolftraderfutures.com, and you can log on there. There's actually a page there that has a free email list where you can sign up and get on the free email list. So I would suggest you do that first, and then you could actually become a free member on the site. And there's a lot of good information there. So just very quickly, Wolftrader Futures. So the mission of Wolftrader Futures is to make sense of financial markets. And so that's one of the reasons why I'm doing these webinars all the time, is because I want you to understand what's going on with the markets. And so it needs to make sense. I mean, it's one thing to be able to trade it. It's another thing to make sense of it. We educate you on planetary cycles and influences. So different cycles that relate to the market. The Federal Reserve, we educate you on the impact of the Federal Reserve, which I'm going to talk about today, which ties into the inflation argument. And we make we provide the highest probability market alignment. So when I say highest probability, I mean I'm putting together the cycles movement with the Fed activity to give you what I believe is the best entry on these markets. We strive to provide excellent customer service and answer questions fast. So that's another thing too. So if you guys ever have any questions, you can head on over to the site, and there's actually a chat there that you can chat us on if you have any questions. So let me start out with an introduction here. So here's my quote of the day. A lot of people talk about bubbles, but what does a bubble mean? It means different things to different people. This is a quote that Dr. David Paul made on Larry Pesavento's show the other day, which is, a bubble is a market that is rising in which you don't have a position. So that's kind of a humorous quote. In other words, if the market is rising and you're just sitting on the sidelines, you say, well, that's just a bubble and it's going to burst. Okay. So I think what a bubble was in the past and what a bubble is now are completely different, because now we have the Federal Reserve in there. So, my view on a bubble is it sustainable? Is price action is able to continue going higher based upon what's going on, the economics, the Fed. And so I would argue the prices are able to continue to go higher right now, particularly in the stock market. And if you continue to look at the model as it was in the past in terms of a bubble, I don't think this market's going to make any sense to you. It's very tempting just to look at the market and say, oh, the prices are high, so it has to be a bubble, it has to go down. But we need to understand what's going on with the underlying dynamics. This is a bubble is Tesla, I guess. I mean, I think it's a pretty powerful company, but another thing that people are talking about too is the valuations of stocks right now in terms of PE ratio. And we need to understand two things. The Fed is in there, number one, and number two, earnings are in the tank because of COVID. So of course the PE ratios are going to be, terrible right now. So I don't think that's really a good metric to use. But yeah, everybody's in love with Tesla, that's for sure. It's a great company. Fear and greed index. So this is a sentiment indicator. So this tells you where we are in the market. So I'm going to do a brief overview of the S&P before I get into the inflation talk here. We're at 59, which is a little bit greedy. It's nothing crazy. It's not through the roof. This indicator can get all the way up to 100. I would say it can get up to like 98, and it can get all the way down to about 2%. And we saw these two extremes on the most recent rally in January, and then decline all the way into those March lows. So, but this is good to look at just to get a basic backdrop of the sentiment. And this is a CNN fear and greed index, and you guys can go over and check it out. I like it a lot. They use 7 different measures of fear and greed, so it's not just one thing. It's not just like put to call ratio or something like that. This is the fear and greed over time. So you can see here in January we were at this peak, and then of course we had the big decline here from the coronavirus, and then we saw our low down here in the March, and now it just kind of came up to this mid-range here. So that's interesting because the NASDAQ is pushing to all these all-time highs, and the S&P is very close to an all-time high, and yet here we are, not with an excited sentiment here. So, I mean, I think on balance, I say that's bullish because, if we were at some type of a high, I would expect this number to be much larger up into here. So, next slide here, we're going to talk about, these are just some of the forecasting tools we use here. I use the Fed juice, which is really the most important indicator that tells you how the markets are trending in relation to the operations of the Federal Reserve. And we look at multiple operations, multiple time frames, and that gives us an idea of where markets are heading. And I've now correlated this to multiple markets. It's not just the S&P now. I'm actually able to correlate this to the S&P, metals, energy, currencies, and cryptocurrencies. Okay, the crypto is a little bit light on the data because I typically need about 10 years of data to get this statistically significant, but I did put up a Bitcoin Fed juice. It's very light on the data. But we do have it, and it's posted every day on the website. So if you subscribe to a newsletter, it's updated around maybe 2 o'clock, depending on what the Fed is doing, usually by 1:30 or 2. Sometimes the Fed goes crazy, like in March, and they kept buying through 3 o'clock. They would drop a $25 billion purchase. But for the most part, I can get an idea around 2 o'clock. Okay, Catmaster signal is a combined transit it's a combined signal that uses multiple transits and statistics to give a one-stop map of the markets. Single transit clusters, which is new, which looks at specific clusters of transits and how they affect the market. This is statistically tested against a control group and a chi-square. And then daily statistics, I look at what's the most highest probable day of the S&P, on the days of the week, like what day of the week is the highest probability. So for example, on the S&P, Monday is the highest probability right now. And this is a rolling indicator. And then it tells you also like what's the highest probability reversal day, etc. So these are things that we look at. The newest one is the single transit cluster. So this is an example of the market. This was the early June decline in the market. And you can see, I actually stopped this learning curve. This actually stopped out here. And so this is all future data. So it was able to pick up this decline here in the market with these arrows here, these transits. And these show typically very high probability events, like 85% of the time it has been proven true. I filter the rest of them out. And so this gives us I think this gives us another layer of focus that gives us like pinpoint precision to the day, whereas those other ones are like longer term cycles. This can really give us precision. You can see here after that decline here in June, these transits all started picking up a rise here in the market, which it did. So this is also posted for each symbol, and I update it about every 2 weeks. It's on the website. There's just a lot of content on this website now, but we need to look at this layer upon layer, and that's why I always like to start with the Fed juice, and I think that's a good place to start. But this is just to give you an idea of what we're about here. We're about improvement and getting these forecasts better all the time, and I think we're doing that. I think lately, specifically on the S&P, I think things have been rolling along pretty good here. So uh, let's talk about the S&P. So S&P 500, I look at this index because it responds the best to the Fed. I know that the Nasdaq is more bullish, but the S&P definitely tends to respond better to the Fed. So this is the one that I use. It's more broad-based, but of course, some people like to trade the Nasdaq if they're going heavy on the tech specifically. So this is the long-term picture of the S&P, and of course, the Fed juice is just beautifully moving higher here, and this is a driving force behind the inflation, particularly on the S&P. And I expected this S&P to rebound. This is not a surprise to me. I was talking about this near the lows. I said I expect a full recovery. But what is surprising to me is that we're starting to see this now among multiple asset classes, and I think I know why that's occurring, and I think it's going to continue to occur, and it's going to continue to uh, become stronger and stronger as we go along here. Okay, so this is the Fed juice here. Like I said, on a weekly time frame, these are longer term maturities. I'm looking at the balance sheet. I'm looking at multiple operations here. This is a shorter term view of the Fed juice. Now you can see a lot of people have pointed this out that the Fed has been pulling back on the asset purchases. This is true, but the market is remaining relatively strong here, and that's a good sign. What that means is that the market is actually getting stronger relative to the Fed juice, and that's what I care about. I measure how is the market responding in relation to the Fed juice, and the market's responding very well. So we're very close to the all-time highs here, so it wouldn't take that much to push us back above those highs. And I think on the short term here, we're actually really strong on this S&P. This is a intraday chart of some of the most recent calls that we've had. And you can see here, this is back into May. There was a long position here, covered here, and then another long position here, covered here. This was a failed short here that actually went higher. This was before the holiday weekend, and there was just some really positive seasonals into there. But that was a failed trade, a short trade. This was the most recent short trade that we made, and that just covered for almost nothing. So the idea here is that the pressure on this S&P is just tremendous to the upside. It's very difficult to short this thing. I do put out the short calls when they come. I just don't like it. I think it's just such a dangerous vehicle to short right now, particularly since it's targeted by the Fed, as I measure it through the Fed juice. So right now on Friday, we ended up with this really strong surge up. And to me, this is just mega bullish on this S&P. Even if you have negative cycles and negative transits, if the Fed is strong, it's going to override all of that. So I think what we're seeing now is we're seeing a strong Fed, but I think we're also starting to see a confidence now of investors into this market now too. So I think that coupled with that sentiment, I think we still have the potential for a lot of room to go higher. This is I know this chart looks like a Christmas tree here, but this is the S&P daily chart that I post. And I track the Fed juice down here, this red indicator down here. And this is really the most important one. This tells you the trend of the S&P in relation to what the Fed is doing. And that's the red arrow here. But we got a multiple alignment on Friday. Just a lot of buy signals coming in on multiple levels. The planetary speed index, the CAT signal, the single transit clusters. I mean, we just have a lot of positive energy coming into this market right now. So I do expect this market to be heading higher in the coming days. Of course, we will have to wait and see what happens. But my experience is that in general, when the Fed is in there, it's much easier to be long on this S&P than it is short. Shorting is just a really difficult proposition on this market. So there's a lot of, this market in particular, I expected this one to be bullish, of course. But what was surprising me was the other markets that we've seen. So that's the S&P. So I mean, this seminar is not about the S&P. I just wanted to show you that. The next one here is going to be the relative comparison. So I like to look at the S&P versus other markets. So the first thing I like to look at is how does it look versus the tech stocks? Is it relatively strong, relatively weak? So I look at Apple and Google. So here is the S&P versus Apple here. And you can see Apple just has this linear rise here, just beautiful looking profile. Just, linear rises tend to be able to go on for a long, long time. And Google, of course, is still holding up. Not quite as nice as Apple, but it's still holding up. These are all very bullish signs here. So relative to the S&P relative to those is still strong, which is good. That's what you want to see in a rising market. And on Google, it's relatively neutral. So things look pretty good there. The only one that looks somewhat troublesome is the banking index, but that could turn up. It looked like the banks were trying to turn up on Friday, and I heard a lot of analysts talking about uh, adding J.P. Morgan to their portfolio, and I can't disagree with that. I mean, remember guys, J.P. Morgan was one of the reasons why the Fed was founded. I mean, J.P. Morgan kept bailing out the United States, so they made the central bank, and then J.P. Morgan, in theory, is a shareholder of the Federal Reserve. So I can't ever see those big banks having major problems as long as the Federal Reserve is around. So I think those banks, at some point, I think they have to recover. This is the S&P relative to gold, and so this is on a weekly time frame. You can see the green arrows are when it's in a buy, the red arrows is when it's in a sell. And it does a pretty good job of tracking the S&P on a weekly time frame. I mean, it doesn't catch every exact turn, but for the most part, it's relatively accurate. It was in a sell down into here, and then it stayed in the sell during the COVID, and then it went back into a buy in recent weeks. Now it's back into a buy. And the reason I do this is some people believe that gold is true money, and it really, it depends who you talk to, and you could make an argument for that. And some people believe that credit is money, and some people believe gold is money. Some people believe baskets of commodities are money. But I do track this in terms of gold because it does track the market well. And this went all the way down to a 2008 support level, which was a very strong, and it kind of held its ground there. So I think that's a positive sign. So on the weekly time frame, this S&P just looks really, really good. I've tried multiple times on the short term to try to short this. It's just really difficult. It feels like every time uh, you know we try to short the S&P, it's like instant doom. So yeah, gold is a shiny rock exactly. Um, so anyway, so let's talk about this. So inflation. Here we go. Yes, it's very possible. And so this is really, really interesting to me because since I've been really tracking the markets since 2008, I started watching these markets right around the tech bubble, right around 98, 99 is when I first started covering stocks. And that was, of course, an inflationary period. But since really I've covered and had this service since 2008, we've really been in a deflationary environment, except for the S&P, which was floated. Most of these commodities had been kind of in a deflationary period. So this is the first time we're seeing it. So let me talk about what this is. Why do I think this is happening? So first of all, multiple markets are rallying together. Many markets that normally are inversely related, they're going up together, which is interesting, which we will talk about. I'll show you some more slides of that in a minute. Multiple markets are rallying ahead of their cycles. So for example, the metals are just coming into their seasonal positives now, and it's actually rallying ahead of that. So that's a very bullish sign. That's a positive relative market bias, which I talk about. The original QE, quantitative easing, did not make it into the economy. In other words, it did help. It did help the economy indirectly. It helped assets, but You didn't get this big rise in inflation. Okay, this round is. So the argument is that there are more specific Fed facilities now that they did not have before. They did not use to this extent, which is, they first of all, we had a direct stimulus to the consumer. So that is the most inflationary thing you can do if you're just giving money to people to spend. So that just happened. Now, of course, the economy is flagging with COVID, but that was inflationary. You have the corporate credit facilities where they're buying this primary and secondary market debt from the corporations. The Main Street lending facility where they're going to be lending to these larger size loans of 250,000 or more. And of course, the TALF, which I'm going to talk about more, that is directly to the consumer, and that's a bridge that they're making. Um, these rises are occurring in these markets in spite of a strong U.S. dollar and COVID depressed economy. So why is this happening? I mean, that to me, that's a big sign that something larger could be coming around the corner, because you have a strong dollar and you have a weak economy, yet you still have these rising prices and assets. So that's interesting to me. So these are some of the arguments I'm making, and I think we're still very early into this, but I just want to talk about the signs that I see. So first of all, this is the US dollar. You can see that the dollar is extremely strong. This is a 200 versus 500-day moving average. The dollar has been extremely strong, and I think this is largely due to the fact that the Fed was able to hold off on those negative rates. And so in that race, we are ahead of the rest of the world. So, interest rates are low, but not as low as they are in other places. So that's fine. I mean, big deal about that. The dollar's strong. What does that mean? Well, typically you don't see rising markets when you have a strong dollar, because if it's priced in dollars, it depresses the price. But yet here we are, and even with the COVID, this S&P is still just consistently rising, and the 200 versus the 500-day moving average never even really got close to crossing on this COVID decline. This is the COVID decline here, and you can see it just picked up right where it left off here. And so that profile is still intact. It still looks good on the long term. And so that's a stable sign there too. Now, so typically, it's like I said, when you see a strong dollar, anything priced in dollars is going to have a depressionary effect, and it's not having that. Okay, now here's the next one that's interesting. Here's the bond. This is the 10-year bond. So this is the one that's very interesting too, because again, priced in dollars, yet it's rallying. And then typically we've seen in years past, before the Fed was so strong, we saw that the bond and the stock market had inverse relationships, but not anymore. We're starting to see multiple markets here rising, and it's occurring across the board. So you're seeing this decoupling effect that it's not explainable when you look at it in terms of traditional economics. You have to understand what the Fed is doing. Okay, so those are my first three examples there. The dollar is strong, equities are strong, the bond is strong. Okay, very strong market. The bond market's even stronger than gold. So let's talk about CPI here. This is inflationary data. So if you go and look at this, this is back to 2000, and this is 2020, where we are now. If you take a first glance at this, you might say, well, inflation is near zero. What are you talking about? There's just no inflation going on whatsoever here. But we really need to look at the whole picture of this inflation to understand what this means. Okay, so this is looking at multiple issues here, but let's talk about one that has been inflationary. That is consumer prices for food at home. Okay, so this has increased 4.8% for the year ending in May of 2020. So consumer prices for food at home has increased 4.8% in the year of 2020, with prices for all 6 major grocery store food chains rising over that period. This is compared to a 0.1% increase in prices for all items. So what's going on here? It seems like we have this split in inflation. Some areas there's inflation, some areas there's not inflation. So what is going on here? Well, this graph shows you what is going on specifically. So in terms of the food, so the food inflation is spiking tremendously here. Okay, that's meat, poultry, fish, and eggs. And the food at home is also spiking here. Okay, but yet the CPI is down at 0. So does anybody know why that is? Anybody want to take a guess? Anybody want to take a guess? Well, let's find out. Okay, so why is that happening? Well, first of all, I think this is significant to show these are rising, because these are not going to be coming back down, first of all. But what's going on here? Well, here's the CPI for all categories. These are all items. This is food, all items, less food and energy. And then take a look at this big negative here. This is energy. You see this right here? So this has been a masking variable in terms of inflation, because energy has been so negative and such a big drag on these markets, or the inflationary index, that the way that they measure it is they throw the energy in there, and energy's been in a big problem. So Energy is definitely the weakest of these markets. And let's take a look now at this. So this is next slide coming up here is going to be looking at natural gas. Now, natural gas has been, let me look at this. This is natural gas here. Natural gas has been in a very strong downtrend. And so this is one of the reasons why the energy is so low, it's falling. But I think that there's a good argument here that this is trying to make a bid at some type of a bid at a low into here. It's still got a falling 200-day moving average, but this is definitely one of the weaker markets here. But I think there's an argument here, especially in recent days. Natural gas made a very strong move off the lows. And I think on the short term, I think there's an argument here that natural gas could be trying to make a bottom. So this is a MACD down here. This is what I call a normalized price adjusted MACD. And the reason why I do that is because you can compare previous lows on here. So for example, if this is at $7, obviously that's not the same as $2, right? And so because I normalize it by price, you can start to compare previous lows. So this previous low in 2016, you see that we're actually lower than that low right here. So I think this is really trying to push to a bottom. And think about this too. Everybody talks about, these bear markets that are, about to start, and the bears are saying this, right? But they've been saying that forever. And these markets, many of these markets have been in bear markets for 10 or 15 years. So, these have been going down for a long time. So we're closer to the end than we are, closer to a bottom than we are a top end to these, definitely, I think. So the next slide here is oil. Now, this is an important one because this one directly affects drivers and consumers. So if you take a look here on 2019, we talked about that year-to-year difference in the energy sector. So you can see here, this is the point-to-point difference here, and oil actually saw those negative prices, right? So keep in mind, let's see, sorry, I'm going to read this. Can you put the image on, left side of the screen so we can see the right side of your charts? Okay, sorry guys, let me go back. Let me see if I can make this a little bit more. That way I can control this a little bit. Whoa. Maybe I'll move it a little bit more to the left this way so we can see it. Okay, sorry, I wasn't reading the comments, guys. Can you put the image to the left? Yes, XLE is the weakest of the segment. I've been thinking along the same lines. We can minimize Shane's image. Can you guys see it a little bit better now? Any comments there on this? Yes, better? That works. Okay, great. All right. Okay. So let's go back to what we were talking about here. So anyway, so this is the what I was talking about with energy, and then natural gas is the weakest. But again, one of the things I look at here is a normalized MACD because I normalize it in terms of the actual. It's normalized, so it's like an RSI, so we can track previous lows, and we're definitely at a lower low right now. So I think natural gas could be making a bid for that turn. So the next one here is oil. Now again, I just talked about that before. Oil had those negative prices. So when we look at that May decrease in energy, we're talking about the biggest drop in oil that probably historically we've ever seen. I mean, these prices went negative. So you're talking about from here to here. So when you look at that inflation index, it's not going to stay like that. And look at the bounce that we've had so far in oil. So if oil is bottoming now, and next May we're out into here, let's just say, right, that energy component of the inflation is going to be much stronger. So I think that was kind of a masking variable on the inflation. Okay, next market I want to look at is copper. So copper is important because copper is a very strong industrial metal. And this is one of the most important metals that we look at when we're talking about an economic recovery. So the fact that this is actually rallying into this time that we're in, this COVID time, that's a very bullish sign. And you can see that it just went straight up through that 200 and 500 moving average, and it's looking very bullish. So from an economic standpoint, that's a good sign. You definitely want to see copper on the rise, and it's just been a relentless bull. Okay, copper has been a relentless bull, and this is one of these markets that's rallying ahead of its cycle. So you can see here that copper This is a daily chart, and copper has just been plowing. I mean, these RSI values, usually when you hit an RSI of 93, it tends to turn a market. Copper has just been plowing higher and higher, and copper actually hit RSIs up around 97, and it's still just going higher. Now notice down here that the Fed juice picked this up on May the 20th, and it's been rallying ever since. So the Fed juice was able to pick this up and able to see this rise in copper. But again, this is a very bullish sign, and so you're seeing this across different markets. This is the seasonal pattern of copper. We're actually just coming into the seasonals now. Okay, so copper is due for another big run here on the seasonal pattern. So when you see markets that are rallying ahead of their seasonal pattern, that's a very bullish sign. Okay, so that's just something to consider. Now, I spoke before about the concept of the TALF, and I'm going to go a little bit more into this. I spoke on Larry's show about this, and this is the Term Asset-Backed Loan Facility. This was actually founded in 2008 during the financial crisis, and this is to help the consumer get loans. Okay, so this is for like auto loans, student loans, credit card receivables, equipment loans, leases, floor plan loans, all different types of consumer related loans are done through this program. So right now that they're going to make up to $100 billion of loans available. These loans will be non-recourse to the borrower. And so who's the borrower? Well, let's just do a little flow chart here to talk about this. This is an example of how a TALF program would work. Okay, so typically if you go to get a loan at an auto dealer, okay, so let's say that you're at a car dealer here, you need a loan to buy the car. So how do you get this? How do you get this money? Well, the car dealer has a finance company that will give them the cash. But how did they get the cash? Well, they take all of their loans and they package them together into something called asset-backed securities. Okay, and what they do is they slice these up and they slice these up into different grades, different tranches. And so they need investors to come and buy these loans. Okay, so this is how you get your car loan. The finance company goes out and then the investors come and buy these. Okay, and if there's no investors to buy these, then the consumer credit dries up. Okay, and so what happened during the financial crisis is that these investors, for whatever reason, couldn't buy these asset-backed securities anymore, and either because they were out of cash or because no one would loan them the money. So what happened is the Fed stepped in and they said, okay, we're going to become the loaner to these investors to buy these asset-backed securities. And so this is what happened with the Fed, and they came in and they did this and they restored the credit markets. And so, but this is important because this can have an exact inflationary effect on the consumer. So before, when we talk about things like purchasing mortgage-backed securities or purchasing treasuries, that's not so much on the consumer level. This is. And this went away in 2010. It went away pretty quickly. And I think the reason why it went away was because it's higher risk. There's definitely higher risk here to buying these asset-backed securities. But it did support over 3 million car loans, 1 million student loans, 900,000 in small business, no losses, and they earned $1.2 billion in interest income. So it was a success the first time they did it. And I think that this is the reason why that the government took over the student loans. I don't know if you guys know that. Well, they started guaranteeing the student loans. And I think the reason the government did that was because they wanted to shut down TALF, but they didn't have enough investors to keep the student loans going. So I think that's why the government took it over. That's just my personal feeling on it. But this is kind of what's going on. So this is going on now in the market. So the Fed has been shoring up the credit markets for the consumer. And so this is having an inflationary effect on the market. This combined with the stimulus checks, this is directly to the consumer. So this is no longer just targeting asset markets. So and this is why I think you're starting to see this show up in all these markets. The next one is gold. Okay, so gold is rising. Obviously, it's in this bull market, and it was already going up here, right? It was already on the rise coming into this 2020, but really it started in this 2019, and then of course when COVID hit, it started this parabolic rise here. Now, this is the most impressive market to me because remember, gold is priced in dollars. So remember, we just looked at the US dollar chart, and the US dollar chart was going up, right? So think about that. The US dollar chart is going up. Usually gold goes down. So what's happening is gold is actually even much stronger than it's showing here. Okay, so when the dollar is weak, gold tends to get strong. So anything priced in dollars has this inverse relation. So usually the dollar has an inverse effect on commodities, but that's not the case now. So with TALF might result in downturn. So with TALF might result in a downturn recession with all the unemployment due to COVID. With TALF or without TALF? I'm trying to read this. So with TALF might result in downturn recession with all the unemployment. I think that the TALF is really to keep the short-term consumer credit going. The risk of the TALF is, I'm going to talk about the risk of that actually very quickly here. So here's the risk of the TALF. These are non-recourse loans, okay? So what that means is that the Fed, okay, so you have to put up, for a non-recourse loan, what happens on the loan is that you put up collateral, okay? So let's say that you take your automobile, okay, and you put that up for collateral, and the car is worth $100,000, right? And over time, and they allow cars to be collateral in TALF. Over time, let's say, I know it's an expensive car, but let's just say it's worth 100,000. So let's say over time, your car goes down to $70,000 as a depreciating asset, and you borrowed, let's say you borrowed 100,000. I know they're not going to let you, let's say you borrowed, let's just say 100, okay? If you default on that loan, the Fed cannot come back for the $100,000. They can only come back to whatever your collateral is worth. So the difference there, the minus 30,000 there, is the Fed's risk. So because it's non-recourse, they can't go after these borrowers for the full amount. So in that sense, it's risky. If it doesn't work out, if the economy does take a downturn, then the Fed could actually lose money on that. So that's what the risk is with that. So, but right now, I think it was a brilliant move by the Fed, and I'm going to show you how fast they acted on this. They acted much faster than before. This is the S&P, sorry, this is the gold on this daily chart that I track. And, we've had quite a few trades into here. We've had a long trade recently in here on this rally. But the Fed juice picked this up on June the 15th. And the Fed juice has been in this rally since June the 15th. So this Fed juice has done an excellent job in tracking these longer term trends. And this is the reason why I like the Fed juice so much, because it doesn't get whipped around. And if you just looked at this price, you may not see a trend there, right? You don't see a trend, it's just going sideways. But right here, the Fed juice picks this up and spots the uptrend, and immediately it tells you, hey, look, gold is going up, and it stays in this uptrend the whole time. So this is why the Fed juice is so valuable, because the Fed juice tells you these trends. So I always assume that I'm in a trend, even if the market looks like it's going sideways. And so this is why I always align markets with the Fed juice, because you never know when a market is going to go from sideways to break out into a big uptrend. And so that's the thing. So you can be thinking you're doing great here in these sideways markets, and then all of a sudden it just keeps going, right? But the Fed juice is going to tell you that. And so that's why I always line these up with the Fed juice. So this is the gold cycle. So gold, these metals are actually just coming into their positive seasonals, right? So we're in early July here, right? We're in July the 11th today. So we're right into here. Look at this. Gold is already rising into these rising cycles, right? So think about this. You have the strongest part of the year coming up for gold, and it's already rising. Why does the Fed juice give different dates? Okay, let me answer that question. Why does the Fed juice indicator give different dates for different markets? Good question. So let's talk about this. So there's different ways that I measure Fed juice. This indicator right here, this one down here, is the one that I call the Fed juice. This is my Fed juice master signal 3.0. What this does is this measures the relative strength between a market and what the Fed is doing. And then it tells me if the market's doing better or worse than the Fed stimulus. So I'm able to measure each market separately. Okay, so it's like a relative strength indicator between what the Fed is doing versus what the market is doing. So even if you have a weak Fed, but the market is getting strong, it's going to tell you that. And so each market has different turning points and different dates. And if you go back here to the S&P, you can see that that one turned, that one just turned up here on July the 9th. So there's different things going on in different markets, obviously, but it picks up these big sweeping runs. You can see here on March 25th on the S&P. This is the S&P, by the way, this white one. It had this big sweeping move all the way up here to May the 11th, then May the 18th, and then so on. So it picks up the bigger sweeping moves on the market, but this is relative to of each market to what the Fed is doing. And so this is what really took me a long time to figure out how to do this on other markets. So like it was for the S&P, it's relatively straightforward because they're targeting the S&P. But for other markets, it was a lot trickier to figure this out because some of these actually have inverse correlations to the Fed. So this was a big breakthrough. So now we have this on other markets than just the S&P. So hopefully that answers your question. So we'll get back here to the seasonals. This is the gold season. So we're just entering this positive seasonal on gold, and gold is already taking off. So that is, that's very unusual, okay, to see all these markets continuing to go up together. Next chart here, I'm going to talk to you guys about the TALF, okay? So this is the chart of the TALF, the ABS spread. So this measures the risk of the asset-backed security spreads. So this was back in 2007. So you can see this is when Bear Stearns started having the problems, okay? And so slowly these asset-backed security, the risk of these, the spread was rising, kind of like a junk bond does, right? And then the Lehman Brothers collapse happened, and then you had a period here of 71 days before the Fed announced its TALF. This was in 2008. And then it took it, I mean, look at the spread here. It was like 1,600 points here on the TALF. And then it took it many, many months for this to come back down, for the spread to get back down to 200 basis points. And so that's what happened on the first round here. And it took a long time. I mean, they had multiple rounds that they had to come in and ratchet this program up. But this time it was very different. So this time when the Fed came in, it was a matter of days. Okay, so this is the pandemic. So this was in March. So the Fed's starting to cut. This is when the Fed does the 50 basis point cut. The 100 basis point cut. The New York lockdown begins. Okay, so then all of a sudden you see these spreads are starting to rise again on the asset-backed securities. And why is that important? Well, the consumer can't get credit. So this is directly related to the consumer. This is not Wall Street. This is Main Street. So it only took 3 days from the time that this happened for them to announce TALF. Okay, so this time instead of 71 days, the Fed responds in 3 days. And then you start to see very rapidly that these spreads came back in line down to around 200 basis points. So the Fed learned from their experience on the first time to take care of this. But I think this is one of the reasons now why we're starting to see these markets start to go up now, because the credit markets have been recovering. Now, there is a weak market. There are some weak markets here, which I'm going to talk about. One of them is corn. Now, the grains have been very weak, and corn is the weakest. But I would argue here that corn, if you look at this relative basis, because I have this normalized MACD here, okay, corn, if you take a look here, where it is here, it's actually matching its lowest value here. You see this right here? It's matching this level over to here. So, and I think in recent days, corn made a very big move off the lows. Okay, so corn, I would say corn and energy has definitely been weak, but I think you can make an argument that some of these grains are trying to move off their lows. So corn has been, I'm going to show you this daily move here. Now, this is the big move that corn recently made. So again, here's the Fed juice. June 26th, Fed juice catches this ahead of time, okay? And it starts this big move up. You see this right here? That's a monster move. This was the crop report into here, okay, the USDA crop report. But this is a big move. So this looks impulsive. For those of you who are Elliott Wave people, this looks like an impulsive move off the lows. And this is kicking into an uptrend. So now why is this important? Well, corn has been in this huge downtrend. It's slowly been trying to drift higher. It went down and boom, it went up. So the overall movement of corn has been to be trying to move higher. So, well, we know it's in this big downtrend, but if you look at corn on a seasonal basis, during this whole time, it's been in this negative seasonal basis. You see this right here? So this is supposed to be a negative time of the year for corn, yet it's going up, right? So look at this. It's during this whole negative season, corn has been drifting higher. So to me, that's a positive sign. Okay. Now corn is the weakest of all the markets. Yeah, corn pulled back on Friday. Yep. Corn is the weakest of all the markets. Uh, but other markets, such as wheat, are finally getting stronger. So you could make an argument here that wheat is at hitting a bottom here. Okay, you could see this. This is the first time this 200 moving average has crossed this 500 in like 10. It's like years. I mean, this thing has been going down for years and years and years, and this is the first time it's trying to make a bottom. It's trying to make a low. So you have these multi-year, sometime in some cases over a decade of a bear market. You can argue that these are trying to make lows now. So if these weaker markets, okay, if wheat, corn, oil, natural gas, if these actually do come in and make lows, then you could definitely start to see a pickup in the CPI and the inflation rate. Okay, so let's talk about what that means. This is kind of my summary slide here. I know this is getting a little long, but this is my summary slide here. So maybe we need to change our inflation definition. So here's why. Multiple markets are beginning to rallying together in spite of a strong US dollar. So that's something that we haven't seen. That doesn't go with the normal inflation view. New Fed programs may be leading to real price power. So we have to look at this in the perspective of the Fed and these programs that the Fed is implementing, that we are now targeting Main Street. And so you might start to see increases in prices and the CPI like we've seen in the stock market in the past. So that's very possible. Multi-decade bear markets in commodities may be ending, and I just tried to show you some signs of that. It's possible that these bear markets are coming to an end. Now, this is an important one because people ask me about the inflation bonds and should we be trying to hedge inflation? Well, typically inflation talk is rising price and interest rates, okay? But that may not happen. So when people think about interest rates or inflation, they instantly say, well, higher interest rates. Well, that may not happen this time. Look at what's going on right now with the bond. The bond's going up with the equity market. So you may not get that this time. You may not get inflation with higher interest rates because that would crush the economy. I mean, it would crush many things. And also, if the Fed's buying these, these bonds, I mean, think about that. They're holding these bonds. They don't want the interest rates to collapse. They don't want their bonds to collapse. So, there's a lot of interest here to keep this bond market higher. So don't automatically assume that because in the past that you had high inflation, you had high rising price with high interest rates, that may not happen again. And so I know that's hard to put together and it seems like it doesn't make any logical sense, but that might be what's happening now. So, I'm just trying to make sense of this, but the one thing I do see is we're seeing multiple markets rising across multiple asset classes. And there are, like I said, there's still some bear markets, but bond, equities, and gold may rally together. And that's what's happening right now. Okay. I mean, and again, this may take people by surprise because before the Fed was not targeting the consumer as hard, and they are now. Okay. Any turn up in grains, energy, any of these turn-ups may lead to a rapid increase in CPI. Okay, so you might start to see the CPI go up very quickly. Okay, now I'm also going to throw one more other thing into here, which I think is significant. Okay, I think this is significant. I don't know if any of you have been, if you go out to get this curbside takeout from a restaurant, or if you go to buy prices, there's a COVID charge now. I don't know if you've noticed that, but restaurants, businesses, they're charging you a COVID surcharge now. Okay, so that's inflationary. So now that's like a tax that businesses are starting to put on. And businesses are going to have to try to make up ground for this economic slowdown, right? So they're going to probably raise their prices because they're arguing, hey, look, I got to raise my prices to make up for this lost ground, et cetera, et cetera. So, and then the other thing is too, is that you have this economy that might have this pent up demand. Remember, we didn't have a regular recession. This was a natural disaster, right? This was a virus. So the economy could probably come back online much, much faster than it normally would. Okay. And when it comes back online, you have all this stimulus out there. You have all of these things out there. You could get rapid increases in prices. So the one thing I would say to everybody is that, more research and monitoring needs to be done. These are just some early signs that I'm seeing, but I think from the perspective of the Fed, I think this makes sense, and I'm trying to make sense of what's going on, and trying to trying to make sense going forward. So um, I think with that, I will open up the floor here to any questions. For those of you who just joined us late, I'm Shane Smoleny from Wolftraderfutures.com. That's the website. And my email is shane@wolftraderfutures. And yeah, I'm reading these comments. Raise prices, people will not buy. I will vote with my feet and my wallet. Okay. Yeah. There's a lot of uncertainty right now for sure. And so all that I'm trying to do is monitor the charts and to see what they're saying. So thanks for doing this. No problem, guys. I'm going to keep trying to do this weekly if we can, but I want to make sure that we have good topics to talk about. I think today was definitely an important topic. This inflationary concept is something that I haven't seen. I just haven't seen this before, and so we're starting to see it. For those of you who are curious, I have 5 different newsletters out. So we cover the S&P, metals, energy, currencies, and cryptocurrencies. The top 3 selling newsletters are S&P, metals, energy, but we do have people in the currencies and the crypto, and all of these have Fed juice to some degree. Okay, so um, I will only put the Fed juice up if I feel like it's a accurate forecasting for the market. So for the S&P, of course, it's accurate. For the metals, we have copper. I put it for silver, and I put it for gold. And for the energy, I have it right now. I have it for oil, and I have it for natural gas. For the currencies, right now, I have it for the euro, and I have it for the pound. This is just the Fed juice. And then for the crypto, I have it for Bitcoin. So there's something here, and this is updated every day on the site. So yeah, let's see. So anyway, so I'm trying to read these comments. Anyway, so that's it for the newsletter. So if you guys want to reach the site, let me just tell everybody where they need to go if they want to go for more information. You go to wolftraderfutures.com, and up here on pricing plans, you can see these different newsletters. Each of these are $39 a month. There's a 7-day trial. So definitely go over there and check it out. At the very least, put in your email. You can get free email updates on the website. And yeah, so each week I'm going to be coming on here doing a webinar. There's a lot of different topics to talk about, but on the newsletter, just to clarify for everybody, on the newsletter you get a monthly newsletter. On the S&P, I'm updating this pretty every day or two. I actually have a Remind app now, so you guys get messaging. So for each newsletter, you get messaging on your phone. You'll get a text message if something happens. You're going to get the Fed juice. You're going to get the single transit clusters. So you're going to get the CAT signal. So there's a lot of good information here on each of these markets, but each person is different. So some people like to focus on currency. Some people like the S&P. So there's something there for everybody. So head on over there if you want to take a look at that. All right, so what I'm going to do now is read some of these questions. Why do you do just the S&P? How about the NASDAQ? Okay, let's talk about the NASDAQ. I used to follow the NASDAQ very closely, but I find that the S&P tracks very closely to the Fed. The NASDAQ obviously it's a very bullish vehicle, so some people might buy the NASDAQ when the S&P is bullish, but the NASDAQ is a little choppier and it's kind of hard to follow. So that's the reason why. I mean, I can revisit it and see, but my experience is that when you track the S&P, you almost have like a perfect fit with the Fed. So the Fed juice is unending. Yeah, the Fed juice, because the Fed is so large, these effects, like I call them like tidal effects, like it has effects in every market. So I'm able to pick up those effects in the markets, and that's that's what you can get every day. You can log on, and right around 1 or 2 o'clock, you can see what the Fed juice is doing in each of these markets. NASDAQ is just 5 stocks. Yep, it is. But again, that's the reality of it. So I can look into that NASDAQ, but my experience in the past is that it's just not as accurate. Like the NASDAQ can be leading ahead of the Fed juice, whereas the S&P, I'll go back to this S&P here just to show you. The S&P tends to have much nicer rolls on the Fed juice. So this S&P, this Fed juice, these red arrows are the Fed juice here, but it tends to just to pick up. It's just a much smoother market. I mean, and even though we did have a very choppy period into here, when the COVID came in, this recovery rally was anything but smooth. It was very rocky. Notice how the Fed juice stayed into its buy signal, was very smooth, and it did not get kicked out of any of that volatility. So, I like that. I think the NASDAQ, it's tougher. I mean, it's not impossible, but it's definitely tougher to track. But the S&P just tends to be much better. So right now, it's just coming off. It just came into a buy. I mean, just like a couple of days ago. So, there's upside potential here on this S&P. Could be for a while. Could be for a couple of weeks. Thanks, Shane. Great work. Hey, guys, you're welcome. It's my pleasure. I really enjoy these seminars, and I enjoy interacting with you guys, especially when you guys chat me on the Wix app. You're welcome. And would you use the SPXL and SPX to trade S&P? I mean, you guys can trade whatever you want. I mean, this is futures. I just track futures. This is what I do. I'm a CPO. So this is what this is what I watch. I watch just futures, but people trade different instruments all the time. I mean, that's really up to you, what you want to do. I'm just providing this information to you guys, but people use all different types of ETF vehicles, triple, double, whatever they want to use. But this just gives you the idea. And again, I think this is good just to give you the broad-based trends. And then, of course, we fill in all the details here with the rest of our forecasting tools. So, but the best place to start is definitely the Fed juice, as it gives you that overall trend to the markets. Any other questions? Any other questions here? All right, guys. So I think I'm going to sign off here. I really appreciate you guys coming out today. And for those of you, again, who just came in late to the seminar, you can see more information at wolftraderfutures.com. And you can sign up for our email list or sign up for the newsletter. Each newsletter has a 7-day free trial. So I think I'm going to sign out here. So thank you so much, everybody. I appreciate it. And we'll see you next week for another topic. If you guys want to see a topic, this is important. Send me an email or send me a chat, and I will definitely do a topic on a topic that you want to do. So that's really important that you guys are getting the input onto these seminars. But that's basically it. So I will talk to you guys next week, and have a great weekend. Stay safe, stay healthy, and I will talk to you soon. Peace out, everybody.